Hi guys, it's Phil again, back with part 2 of the financial dictionary. And yes, I am wearing the same clothes because I tried to go to sleep, I couldn't sleep, so I decided to record the video. And honestly, I couldn't be asked to get changed and just lie, you know what I mean? Say like, oh yeah, it's a different day, okay, whatever. So in this video, I'm going to be going over 11 terms that you'll hear throughout your financial journey. And like in the last video, I'm going to be putting timestamps down below so you can actually skip through any of the things that you don't want to know, or you can skip between things that you kind of want to learn. Now let me shut up and let's go straight into the video. Number 1 is Financial Services Compensation Scheme, or FSCS. Most financial service firms like banks and brokerages are signed up to the FSCS essentially as insurance for investors' money. So if the bank or brokerage goes bust and isn't able to pay back its consumers' money, the FSCS will step up like a superhero and pay you up to £85,000 per eligible person. Number 2 is a first-time buyer. A first-time buyer is someone that has never owned an interest in a residential property in the UK, or anywhere else in the world for that matter, and that intends to live in the property as their main residence. Number 3, that was 6, sorry. Number 3, inflation. This is the general rate shown as a percentage at which prices of goods and services in an economy increases. This means it will affect what you can buy for the money that you have, with items being more expensive, meaning you can buy less for the money that you have. For example, if you buy 100 oranges for £100 one year at an inflation rate of 2%, which is usually the target for most of the world when it comes to inflation at least, the following year you would need to spend £102 for the same 100 oranges. Number 4 is interest. The cost of borrowing money is represented as interest, which is typically expressed as an APR, like I talked in the previous video. For savers, it refers to the percentage you will receive from the bank in exchange for allowing it to borrow your money. In other words, putting your money in the bank account. For example, if you borrow £100 at an interest rate of 10%, you'll be required to repay the loan in full together with interest, which comes to £110. Number 5, overdraft. This is a method of borrowing money from your bank through your current account. It's what happens when you spend more money than is available in your current account. For example, if you have £10 in your account and you buy something that costs £20, your account will show -10 because you're now in your overdraft. Usually overdraft fees are stupidly high. You'll be charged on any borrowed money. So when setting up your bank account, you'll have the option to either turn on or turn off the overdraft. If you choose not to turn it on, your transactions will just bounce if you don't have the available money in your account. In other words, it just won't go through. Number 6 is property. Property refers to anything that a person or company has legal title to, and that gives owners certain enforceable rights over. Cars, business equipment, furniture, and real estate are all examples of property, which can either be tangible or intangible. In investing, property usually refers to real estate like buildings, warehouses, offices, etc. Number 7 is shares. These are viewed as ownership stakes in a company. A business, for example, might be divided into 1,000 equal parts, each of which is referred to as a share. You could say you own stock in Apple, or you could say you own 10 shares of Apple. Either way, you own a tiny little piece of Apple. Number 8, share outstanding. These are all the shares of a company that have been issued and held by investors or the company itself. Number 9 is standing order. This is an instruction that you can make to your bank to have money regularly and automatically transferred from one account to another. For example, you can set up a standing order to pay your rent each month. Number 10 is tax year. A tax year is a period of time defined by the UK government for dealing with financial matters. Typically, it lasts from April 6th to April 5th of the following year. During the tax year, there are limits set for individuals, including a £20,000 maximum ISA allowance, a £4,000 maximum LISA allowance, a £12,750 personal tax-free allowance, and so on. Additionally, it specifies when businesses must submit their financial statements to HMRC and also self-assessment tax returns. And lastly, number 11, variable interest rate. This is an interest rate on a loan that will fluctuate over time because it is based on an external metric, such as the interest rate set by the Bank of England. Well, I think that covers pretty much everything that you need to know as a beginner so that they can't fool you. So I hope that you enjoyed part 2 of this video. Let me know in the comments if there's anything that I missed or anything that you kind of want to talk more about. Thank you so much for watching, and I'll see you next time.